So we've reviewed some of the causes for the financial crisis. We've talked about the various storylines or narratives, as people call them. We've even voted with our ballots as to what we think is the true narrative. And it seems to be if not the consensus, at least the plurality thinks that we need more regulation rather than less, or that at a minimum our regulators did not do what they were charged to do. So around the world, but particularly in the US and the UK and the EU, massive reevaluation of how we do business has gone on. Massive reevaluation. You notice I didn't say massive change in how we do business, just massive reevaluation. And it will be up to you to decide whether we have changed or whether it's business as usual, but with a lot more regulation and safeguards and some changes around the edges. In the U.S., this reevaluation produced a law that I mentioned earlier, Dodd-Frank. It's actually the Dodd-Frank Consumer Protection. The Dodd-Frank Wall Street Reform and Consumer Protection Law. It's a mouthful. We refer to it as Dodd-Frank. Again, Senator Christopher Dodd, senator from Connecticut, chairman of the Senate Banking Committee, Barney Frank, congressman from Massachusetts, chairman of the Financial Services Committee in the U.S. House of Representatives. New administration comes to power in January of 2009 in the teeth of this financial crisis. Most of the bailouts have already been done by the previous administration. And President Obama, new President Obama, appoints as his senior team Timothy Geithner as Secretary of Treasury, who during the financial crisis and leading up to it for many years was the president of the Federal Reserve Bank of New York, a key player. He also Ben Bernanke, the chairman of the Fed, goes on because his term as chairman doesn't expire until 2010. Larry Summers, who wanted to be Secretary of Treasury and today wants to be Ben Bernanke's successor, we may come back to that, star of the film that you watched, Larry Summers gets appointed to a White House council, National Economic Council, where he has the president's ear in terms of shaping reform. There is a giant, and I say giant both in terms of his accomplishments and his skills and his size in the U.S. on the financial services and economic scene, and his name is Paul Volcker. Anybody ever heard of him? Paul Volcker? He at one time was the chairman of the Federal Reserve Board. I often say that one of my more proud moments in my career was the opportunity to serve with Paul Volcker at the Federal Reserve in the late 1970s. Paul Volcker is at this time about 82 years old, and he's also about 6'7". He's a commanding figure, and has never worked in or for a bank. So he has no conflicts of interest. He is the term straight shooter? You know that slang? He tells it like it is. He is, he's respected by all parties. He is appointed as an advisor to the president, but we know from the warning that Larry Summers does not play well with other people, right? As somebody said, he doesn't tolerate fools or anyone else, right? Well, Paul Volcker is certainly no fool, but he is somebody else. And so Larry Summers goes about making sure that Paul Volcker, as an advisor to President Obama, is driven out, is not listened to, does not have the president's ear like Larry Summers does. So for whatever reason, President Obama comes to office and he basically inherits the same team from the Bush presidency that caused the crisis in the first place. The only missing player in the new team is Hank Paulson, who was Bush's Secretary of the Treasury. I mentioned him yesterday, former Goldman Sachs CEO. He's gone. But everybody else is the same. And so it comes to developing a plan for reform. And the catchphrase of the day was, as an aide to President Obama, who is now the mayor of Chicago, the city of Chicago. His name was Rahm Emanuel. And he said to a reporter who asked him about financial reform, "What are you going to do?" And he said, a crisis is a terrible thing to waste. A crisis is a terrible thing to waste. And that had a certain amount of, had a lot of appeal to a lot of people who were hungry for meaningful reform. And by meaningful reform, I mean breaking up these institutions that we consider now and considered then to be too big to fail. So big, so complicated, so interconnected, so opaque that we feared that if they were to fail, they wouldn't just fail alone. They would take other institutions, some large, some not so large, down with them and throw this financial system, global financial system, into utter chaos. That was the reason given in 2008 at the time of the actual bailouts, and that was the mentality present in the White House and the Treasury in early 2009 under the new administration. So when Rahm Emanuel says a crisis is a terrible thing to waste, people said, at last we're going to have meaningful reform. Structural reform. Breaking up the too big to fail banks. Taking these agencies that I listed for you yesterday, the Fed, the FDIC, the OCC, the SEC, the CFTC, and others that I didn't even mention, and making some sense out of the regulatory apparatus, something probably more like you have here in the Ukraine than what we have at home. So the world waited to see what the administration was going to come up with. And in the spring of 2009, the Fed delivered a blueprint, what it called a blueprint, not a bill, not like HR 2266, which I gave you, but just a general outline. And it was very disturbing to many people because it did not call for structural reform of the financial institutions. It did not call for consolidation of any of the regulatory agencies and eliminating overlaps and redundancies among them. It was pretty much business as usual, despite all of the verbiage. There were some good things in it, for sure, around derivatives regulation, nothing dealing with the credit rating agencies to speak of. There was a new bureau to dealing with consumer affairs. Time will tell whether that was a good thing or not. So there was a sense that this idea of a crisis being a terrible thing to waste was just rhetoric, that they had, in fact, wasted the crisis. Obama wanted to get the bill passed and enacted, signed by him by April or May of 2009. Well, that wasn't going to happen. The legislative process in the U.S. is very, very complex. There's a book called Act of Congress that was written about Dodd-Frank, about the process that it went through. To shorten the story a little bit, we get to January of 2010, and there was a senator from my state. Some of you may have heard or read about Ted Kennedy from the Kennedy family. He served as senator from Massachusetts for 47 years. And in 2009, summer, he died of a brain tumor. He was a liberal Democrat, and he from Massachusetts, which is considered the most liberal state of the 50. And so in January of 2010, we had a special election to fill his seat. To everybody's shock, on January 19th of 2010, a Republican beat a prominent Democrat for Ted Kennedy's Democratic seat in Massachusetts. And this sent shockwaves through the American political system, not just Massachusetts. It gave great comfort and enthusiasm and energy to what we now know as the Tea Party. Have you ever heard of the Tea Party in our country? Tea Party? Huh? Well, it's named after the Boston Revolution, the Tea Party, where colonists dumped tea into the harbor rather than to sell the British tea with a tax on it. Yes? Yeah, right. Well, this Tea Party took named after the Boston Tea Partiers, took great comfort on the ability of a Republican in Massachusetts, of all places, to beat Ted Kennedy's replacement. That led, later in 2010, to the Republicans taking over the House of Representatives. But here in January of 2010, the president was a Democrat, the House was controlled by Democrats, and the Senate was controlled by Democrats. Okay? That all changed that November. This was so shocking that the administration said, we have to do something more radical than we've proposed in terms of financial reform. And what they did was, for the first time, they listened to Paul Volcker. Not because they believed what he was saying, but because they realized that the people were saying something to them, which was, we need more meaningful financial reform. And what Paul Volcker was advocating, and what has subsequently become, is something called the Volcker Rule. Volcker Rule. And the Volcker Rule simply requires or prohibits banks from engaging in what is known as proprietary trading and from investing in hedge funds and private equity firms. We'll probably hear more about this from Joanna tomorrow. So that was that's kind of the political backstop to it. This is this cartoon caught my eye because it captures Rahm Emanuel's exhortation that a crisis is a terrible thing to waste. Be bold, be a cowboy, go out and do something big and meaningful, like President Roosevelt did in the grips of the Great Depression in the 1930s. This is what most people and policymakers thought was called for at the time. Structural reform, break up the banks, make them more competitive with one another, make them less too big to fail. Don't have them threatening the economy forever. So instead, what we got was 2,300 pages of law, as I mentioned, followed by thousands of pages of regulations. Can you all read that? So, those of you that put down regulation, we need more regulation. We got more regulation. We got more regulation that is very easily gotten around. As he says, these new regulations will fundamentally change the way we get around them. Won't change the way we do business. It's not going to change our banks. They're going to be too big to fail again. And in fact, not only are they not broken up, but they are bigger now than they were going into the financial crisis. Why? Because Bear Stearns, one of the largest investment banks, was acquired by J.P. Morgan Chase. Countrywide, that I mentioned earlier, was acquired by Bank of America, and Countrywide was the #1 mortgage producer in the country. Merrill Lynch, which was the largest broker-dealer in the country, was acquired by Bank of America. Wells Fargo acquired a very large bank in the south of America called Wachovia. And J.P. Morgan also acquired a very large bank in the northwest called Washington Mutual at the time that it was failing. So they've become even larger. No, not broken up, become even larger. So most of what you see in the Dodd-Frank Act has a counterparty in either the UK or the EU in terms of regulatory reform. And so what I thought I would do is to go through with you some of these major reform elements that are in Dodd-Frank, and where possible, to comment a bit on what the counterpart is to that reform in either the EU or the UK, right? Now, we'll start with capital requirements. Basel, that we've talked about, which is the place where central bankers from around the world meet, or at least I think there's 30 of them that meet in Basel twice a year, through the Basel Committee on Banking Supervision, comes up with these standards. And they are minimums, so countries can have higher standards if they wish. So Switzerland, for example, has a capital requirement on its two large banks that's almost double what the Basel requirement is. Anybody know what the two largest banks in Switzerland are? UBS and Credit Suisse. Credit Suisse. They're huge, so it's were one of them to fail, their assets are many, many times, a dozen times the GDP of Switzerland. So if one of them were to fail, we were talking earlier about Ireland prompting a combination of bank debt and sovereign debt. If either UBS or Credit Suisse were to fail, Switzerland would be next. So naturally, they require higher capital standards. So there are two kinds of capital that you might want to keep your eye on. And I don't know off the top of my head what standard is in force in the UK for your banks, but presumably you're following the same Basel standards, because even though they're not mandatory, in order to be a credible economy, you have to follow them on the world stage. So the two standards are what they call the Tier 1 or the risk-based standard, and the other is the leverage standard. Both follow the same formula of capital on the top of the equation and assets on the bottom. The difference being that we measure capital and measure assets differently in each circumstance. So let me describe. In Tier 1 capital, you can sort out and add in different types of capital. Okay? I'm not going to get into the details of it because we'd all be lost very soon. But suffice it to say that the quality of capital in the numerator differs between the risk-based formula and the leverage ratio. Where the real difference happens is that in the risk-based capital standard, regulators come along and they say, oh, okay, in the denominator, we're going to rate each of the assets according to the riskiness that we think that they hold. So if take cash, no risk in cash, right? So that would get a 0 rating. Mortgages, more risky. That would probably get a 50% rating. Commercial loans, a little more risky still, 100%. Government bonds that you own, maybe 25%. less, so you understand the regulators are trying to determine the riskiness of the portfolio of the bank and then add it all up according to the risk weight. And you end up with the Tier 1 risk-weighted assets. The second measure is you just take the leverage ratio, it's much simpler, you take the total amount of capital, total amount of assets, and that's your ratio. Less precise, because it doesn't include the risk weight, but it's also more dangerous in the sense that what we know, and what you might even consider writing about someday, is that if you tell a bank that it has to keep capital based upon 100% of commercial loans, but only 50% of mortgages, for example, you're creating an incentive for that bank to load up on mortgages. Needs less capital, right? Have to post at a 50% rate. And so we know from the crisis that risk-weighted capital causes unintended consequences. And yet that's where we're going with this, right? Albeit raising the capital levels. The other thing it does is, so we have these two types of capital, the risk-weighted capital and the leverage ratio. When it comes to the too big to fail banks, it says, okay, if you're too big to fail, then you need to maintain an additional capital buffer. And that is between an additional 1% and an additional 2.5%. And so big banks have to maintain more capital than other banks. And there you have it. So I think in your package is a letter that I sent to the Financial Times just a week or two ago. They ran an editorial saying, isn't this wonderful that the Fed has now finalized its Basel III obligations based upon capital. And the very same day that they ran that editorial, on the editorial page, of course, there was a news report that said essentially that banks were well prepared to game the new capital system. That banks could move assets around on their balance sheet and off the balance sheet, just like they did with the old SIVs that we heard here. And that the bankers themselves were not terribly worried at all about these new capital requirements because they knew how to get around them. Just like the two gentlemen in the cartoon in the previous slide. So to the Financial Times' credit, I guess, they realized that some people are reading their paper and noticing discrepancies between what the editors are saying and what the reporters are reporting, and that's a good thing because there's supposed to be a Chinese wall, is there not, between the editorial page and the reporting page? Is there in your organization? Right? Is there? Is this a consensus or unusual? Huh? They're different. Yeah, but I mean, is that? I see you nodding your head, but I don't see any other. Raise your hand if there's a sharp divide between editorial and reporting in your newspaper. No? Well, that's instructive in itself. Does that ever cause any problems?
Don't have many editorials.
You don't have editorials at all, or many?
Not many editorials.
Okay.
We usually write news, and when somebody's writing editorial, it's just two opinion.
Oh, all right. Okay. Gee. Do you have guests that write in your paper that have their own opinions? So it's all reporting. But then reporting,
I think in magazines.
yeah, speak, yeah.
We publish some op-eds in our newspaper.
In yours you do?
Yeah.
Op-eds? Okay, okay. But that's not the norm here, huh?
That depends.
Yeah.
I mean, it happened that here people that don't write, that don't have a lot of editorials.
Yeah.
Usually,
We try to have more news.
we usually have 2 editorials a week.
Okay.
We have a weekly
Yeah.
We have it on site, special place for.
Yeah.
Constant column,
Yeah.
which has nothing to do with editorial.
Let me ask the follow-up question. Do the owners of your papers ever try to influence what you cover or don't cover?
The owner.
Hmm?
Owners.
They what?
The owners.
The owners, yeah.
Good question.
Huh?
Our owner is too far away to influence us. He's in Russia.
Oh, okay.
I don't think he influences. He doesn't care much.
No, but, well, I assume he has local agents, or does he? Does he have local people that act on his behalf locally?
Well, we have in Moscow, we have a director and a chef editor,
Yeah,
and they meet with our chef editor, and they just speak
Yeah.
some or something like that this way. But I think as far as direct influence, we need to.
so the general public, when it comes to your periodical, do they think you have a point of view? Or do they think that you're just a completely objective source of news?
I think here it's considered a good when the newspaper doesn't really opinionate it or have strong point of view. I think it's a good for it's considered that it's good newspaper.
Okay.
If it has strong point of view and if it is point of view of your owner, it's considered very bad news.
That's a bad thing. Yeah.
This is a daily paper. They don't have editorials, but on this one, they do have editorials, and they're very voiceful about what they write. They always take a position.
I see. Okay.
This one is a different style of journalism.
Okay. All right. All right.
I'm an outsider. I'm not a journalist. I'm one of the speakers here,
Yeah.
but I read the papers and I know what they like.
Okay. Well, it's an interesting and a different. Our system is by no means the best, a model, but even reporting, you might call it reporting. It's what you report is a point of view, and what you don't report is a point of view.
There is certainly things like that.
Yeah.
I mean, there is no article that says here's our point of view on the issue. We usually don't do that.
Yeah. Okay. So capital. It remains to be seen whether this is going to be an effective tool going forward. It certainly has not been an effective tool for banking regulation over the past 3 decades. That cannot be argued. And in fact, one of the articles that you have, that is an article about the bill that we're going to talk about later, has in its headline a reference to the obsession with bank capital as the ultimate tool in addressing systemic risk. The second general area that Dodd-Frank tries to tackle, primarily through the Volcker rule that I referenced, is activities restrictions. We talked yesterday about banks being special in the sense that they are chartered, supervised. They have the implicit guarantee of the government behind them in the form of deposit insurance. That's further enhanced by the discount window or the ability of the central bank to lend to a bank in extreme circumstances. They're supervised, they're examined, they play a vital role in the payment system in connection with the central bank, and they are the implementer through the central bank of monetary policy. So they're not like everybody else. They are special. Now, over time, with deregulation and competition, they have, in the U.S., and I would love to hear your comments, over time, they have been allowed to engage in more and different activities. So, I was afraid I was going to do that. I drew this chart up here to kind of outline broadly two structural alternatives for banking. One is shareholders owning a bank, pretty simple. And the other is the model that we have in the U.S. where 90% of banking assets are under a bank holding company. So you have shareholders owning a bank holding company, and the bank holding company in turn owning 100% of the bank. And then non-banking activities taking place either in a separate non-bank affiliate of the bank holding company or a subsidiary of the bank itself. All right? Bank holding company, also called financial holding companies, banks. If I used every page on that easel and asked Natalia to get me another pad of paper, I could not put all of the subsidiaries of J.P. Morgan on there. To go to Chuck's graphic yesterday about measuring the Earth, if I went around this room and every room in this suite of offices and every room on the floor below and drew that bank holding company with all of its subsidiaries, I wouldn't capture them all. Thousands upon thousands of subsidiaries. Some they don't even know they have. So when you hear people talk about banks that are too big or too complex to fail or to manage, think of a room that has one holding company with almost an infinite list of subsidiaries. This creates a problem. So you might have, if you were to pick up the newspaper today in the U.S., you would read about J.P. Morgan about to be fined $400 million for its manipulation of the electricity market in California and certain Midwestern states. doing this through one of these non-bank subsidiaries. If you picked up the New York Times last weekend, you would read about a series of warehouses in which aluminum is stored, owned by Goldman Sachs, where they pick up and move around ingots of aluminum, and in so doing, earn fees for Goldman Sachs and add a fraction of a penny to the cost of each Coca-Cola can. All because the Fed, under Chairman Greenspan back in 2003, issued a very permissive interpretation of the law that said that it was okay for a bank not just to trade in commodities, but to own commodities. And now, according to reports, the Fed is revisiting that permissive ruling because they got a lot of heat for it. Congressional hearings last week, congressional hearings coming up in September, re-examining this issue. So in the U.S., we have the Volcker rule that says that you cannot have within the bank or within the bank holding company proprietary trading. It would be good if we all as journalists, and maybe we already do, have a mental impression of what is permissible and not permissible for a bank or for a bank's affiliates. Do we know? Does anybody know? Okay. It's important. It's important because banks have access to subsidized funding that other private enterprises don't. And to the extent that they're engaging in non-banking activities, they're engaging in activities uncompetitively with other providers who don't have access to subsidized funding. You with me? So it would be worth asking somebody that question, finding out what's permissible here, what's not. The Volcker rule just says that you cannot trade for your own account in a bank or in a non-bank affiliate of the bank holding company, and you cannot invest in private equity firms, and you cannot invest in hedge funds. It's very controversial, but it's not material. Okay? In the UK, on the other hand, they created a commission to come back with recommendations for banking reform. It was called the Vickers Report or the Independent Commission. And the way they deal, and they are going to deal with it because they've already announced it, they're going to do something called ring fencing. It's a little bit like a bank holding company structure. But what they say is, because banks are special, and because we don't want to bail them out anymore, like we did Northern Rock, like we did the Royal Bank of Scotland, like we did Lloyd's and others, we don't want to go through that anymore. We want banks to be just banks, to do loans, consumer and commercial, and take deposits. But when they want to do investment banking activities, then they have to do that in an entirely different subsidiary, non-bank subsidiary in the U.S. context, And it has to have different management. There can be no swapping of business between the two. Okay? And then the EU has adopted a similar kind of ring fencing or idea. They're less far along in agreeing to it. But at the beginning of the last session, we talked about banking union and how important that was. This is one of the reasons why it is important, because if you're going to have a uniform procedure across the European Union, possible and potentially in the Ukraine someday, you have to have a banking union. You can't have every country figuring out how it's going to implement the ring fence. There's a concept that you might also want to get your mind around, and it's called race to the top and race to the bottom when it comes to regulation. Anybody want to venture what I mean when I say race to the top and race to the bottom? Well, if you're Luxembourg and you want to be known as a financial center, right? You want banks to come and set up headquarters there and do business there and hire people there and pay taxes and pay off politicians. Are you going to make damn sure that you have the toughest and the best regulations going? Or are you going to have something more friendly and accommodating to the banks and to the bankers? Huh? The second one. Right. Yeah. You're going to engage in a race to the bottom, right? You're going to be in a race with every other destination that wants to also be a financial hub. Race to the bottom. But if you're the UK, for example, that considers it and the City of London, does everybody know the City of London, that term? Right? City of London refers to a 1.1 square mile area. Has anybody ever been to London here? Couple? Yeah, I've only been once myself. There's a square mile in London that's called the City of London. That's where the financial district is. That's where the Bank of England is. That's where business is done. So if you're the UK and the Bank of England and you want to make sure that your financial system is safe and sound and reliable and respected throughout the world, then you want to be better. You know, you don't want to compete with these outposts in the race to the bottom. You want to have a race to the top. It's also been called a competition in laxity, this race to the bottom. The reason why I say the banking union has to happen in the EU is you take 18 or 28 countries, and any one of them can be the casino. We already talked about what happened when Ireland guaranteed all of the obligations of its banks, put everybody else on the spot. So banking union is very important. Size limits. This is kind of a visceral reaction to too big to fail, that somehow there's a magic limit to the size of institutions. So Dodd-Frank has within it a size limit. Banks cannot be more than 10% of the total non-deposit, I think it is, liabilities of the entire financial system. Some are already above it. The problem with that is that when you come to the next crisis, these are arbitrary standards built into the law. They can also be repealed by the same legislature, right? They also can be waived oftentimes by regulators. So if you come to the next crisis and a significant bank is failing, but there's a healthy bank that can take it over, but if the healthy bank takes it over, it goes over the size limit, what are you going to do? Let it fail and have all the collateral damage? No. You're going to give it a waiver, or you're going to amend the law, and you're going to allow the size limit to become meaningless. Dodd-Frank also instituted very detailed mortgage underwriting requirements. It's sad, in a way, to read the statute directing by rule, not by business practice, but by rule, by law, that banks actually verify the income that the borrower has. One would think that a sound business practice for a bank would be to verify the income, to verify the assets of borrowers, to require that the loan-to-value ratio be no higher than X. So instead, they put it into law because the broker, like the broker in the video, was unconstrained by business best practices. Right? Too big to fail devices. In the U.S., we have this new way of supervising banking institutions of a certain size. There's micro-prudential and there's macro-prudential. Anybody venture to guess what I mean by micro and macro? Well, micro, I go in and I look at your portfolio, your liquidity, your capital, your business model in isolation. Macro, on the other hand, I go in and I look at you in the overall context. What would happen if something happened in this bank over here? What would happen if something happened in your bank to this bank over here? Where do you fit? Where do you fit in the macro-prudential scheme of things? It's good. It's what the Fed and others should have been doing coming up to the crisis. So macro-prudential supervision and regulation is another term that you might put in your weaponry. Dodd-Frank creates an animal called the Financial Stability Oversight Council, FSOC. And it is charged, remember we said over here earlier that the regulators, none of the regulators were explicitly charged with monitoring for systemic risk. Who knew that the whole system was going to go down? Right? Who knew? So in place of that, Congress creates the Financial Stability Oversight Council. Remember, I said this crisis was wasted. One of the ways for it not to have wasted it would have been to consolidate some of the duplicative regulatory apparatus in the U.S., but no, they didn't do that. They set up this council with 15 members, 10 voting, 5 non-voting, where all of these duplicative regulators get together and talk about systemic risk. And they gave it a charter, this FSOC. It's run by the Treasury, run out of the Treasury Department, but its mission is to wring out of the system systemic risk, which is an unfortunate and unrealistic mission because they left in place all of the too-big-to-fail banks. So how can you wring out the systemic risk if you're leaving in place 6 too-big-to-fail banks? The crisis showed us that it's not just banks that cause risk to the system, it's other financial providers. Name one. Does AIG come to anybody's mind and lips? American International Group, the largest insurer in the world, $185 billion. I think that was the number. That it cost the Treasury at the time, the Fed and the Treasury, to bail it out. In recognition of that, Congress charged this FSOC with defining the universe of non-banks that pose systemic risk to the financial system. And FSOC has created something that we call SIFIs, significantly important financial institutions, right? AIG, Prudential Insurance, GE Capital, and soon MetLife, and perhaps others will be defined as significantly important, that is to say threatening, to the financial system, such that going forward they will be regulated not just by their insurance regulators or other regulator of choice, but by the Fed. And the Fed is going to come up with its own capital standards for insurance companies, its own liquidity standards for insurance companies. And what's the largest insurance company in the Ukraine? Local. EXA? That's not local, I don't think. AXA? Is that? It's not. Huh? It's a subsidiary. Oh, okay. Yeah. So that's the largest provider. So.
Maybe you bring in Aranda or AXA.
What was the other one besides AXA? Aranda. Okay. I believe AXA has already been designated by the Financial Stability Board in Basel as what is known as a GSIB, government, I don't know, GSIB. That's a significant player on a global, systemically important firm. Global, significantly better firm. I think AXA may be on that list. So that's what FSOC does. Anybody recognize this guy? Romney. Yeah. Sad to say, he was my governor at one time. Mitt Romney. People were very nervous. We had 3 presidential debates in 2012, and Romney won the first debate hands down. I don't know where Obama's brain was that night, but Romney, we have an expression called "took him to the cleaners." Yeah. Romney took Obama to the cleaners that night. And one of his lines during the debate, they were talking about regulatory reform. Who would know that in our lifetime, banking regulation would be so hot a topic that they'd be talking about it in a presidential debate? But they were. And Romney was critical of Dodd-Frank in 2012, and he said, it's the biggest kiss ever for the New York banks. And I was sitting there as a Obama voter saying, damn it, he's right. He's right. Because it does not break up at the banks. It does not rearrange the regulatory apparatus. It leaves it all in place, and we still have too big to fail banks. And what does it mean to be too big to fail? Well, most academics, most observers of the scene, not all, but the vast majority who have studied this issue, come away saying that if you are a too big to fail bank, you not only get economies of scope and economies of scale. Does everybody know what I mean when I say that? You know what I mean when I say economies of scale, right? Well, economy of scale is simply if I get bigger, then I can buy pencils in bulk and get a better deal on 100,000 pencils than I can on 1,000 pencils if I was a small company, right? And if I'm a bank and I have 1,000 branches, there are economies of scale that go with that. I can rent space from large real estate investment trusts across the country for less when I do it on scale. I can buy my ATMs, automatic teller machines, in bulk. Whereas the local credit union or some bank that only has 100 branches doesn't get that benefit. That's scale. Economy of scope means that you're so large that you can engage in related activities. Sometimes not related activities, as we were discussing earlier with the California electrical manipulation penalty that J.P. Morgan is about to pay. Economies of scale and economies of scope. Those are good things. They contribute to the efficiency of the system. Economies of scale and economies of scope within reason. What do I mean by reason? Well, if you become so scaled that if you fail, you will cause harm to the financial system, that's not a good thing. Similarly, if your scope is so wide and it's beyond the purview of banking, then you're competing with other firms, as we said, on an unfair basis because you're subsidized and they're not. So, in addition to those good things, that is the economies of scope and scale, there is an advantage to being too big to fail, which is the access to funds at a lower rate, right? So let me ask you this. If you're the corporate treasurer for, what's the largest private company in the Ukraine?
System Capital Management Group.
Okay. It's public, yeah, but it's privately owned. Public shares are publicly traded, but it's not owned by the state or anything. Yeah. So if you're the treasurer, corporate treasurer, and you have $50 million that you have to leave overnight at some bank, are you going to leave it at some bank that might fail the next day, or are you going to leave it at some bank that has already proven to be too big to fail by virtue of having been bailed out once? I think the answer is self-evident, that you're going to sleep better at night knowing it's with a bank that's going to be bailed out by the government if it has a problem. And don't just take my word for it. The credit rating agencies, our beloved credit rating agencies, they come along, and when it comes to the debt of these large institutions and the rating of that debt, the credit ratings will say right up front that we are giving this debt offering by Bank of America, by Goldman, by JP Morgan Chase, a higher rating because of the likelihood of the government bailing it out, supporting it, in the event it gets into trouble. So the credit risk of your investing in that bond is less credit risk. Well, if there's less credit risk, there's going to be less of a credit premium that you have to that they have to offer on that bond. It's a safer investment. It's not a risky investment. This survives the financial crisis, this idea of too big to fail firms. And many countries have them, not just the U.S. Barclays, Deutsche Bank, UBS, Credit Suisse, Santander Bank in Spain. Many countries have their own country champion bank that they will not allow to fail, and that have a subsidy in the form of lower cost of funds. The studies that have been done estimate this subsidy at anywhere between 50 and 100 basis points. What's a basis point? 1/100th of 1%. Doesn't sound like a lot. 0.5%, 50 basis points. 1%, 100 basis points. But when you total it all up, in the U.S. alone, it's $83 billion a year, according to Bloomberg and according to the IMF. $83 billion a year. That's more than the entire banking industry made that last year. And where does it come from? Not from the brilliant management of Jamie Dimon, the head of JP Morgan Chase. Not because Bank of America has a wonderful business model in the thousands of branches it has all across the country. Not because the Morgan Stanley made wise decisions. It comes from us, the taxpayers. It's a subsidy. So the subsidy reserve plan that we came up with is very simple. Couldn't be simpler. Dodd-Frank is 2,300 pages, and I mentioned regulations to follow. This bill that you have in your hands in your packet is 293 words. 293 words. And this is how it works. The Fed just has to consult with FSOC. I've just described FSOC. I didn't describe OFR. OFR is the Office of Financial Research, which is an arm of FSOC. Fed consults with them and they say, hey, do an analysis. You come back to us and tell us your best model for measuring this too big to fail bank. And then we'll put it out for comment, like you have to do in the U.S. with most new regulations, particularly a regulation of this size and consequence. We'll put it out for comment, 60, 90 days, and the public, including the too big to fail banks, will have an opportunity to give us their best analysis of what the proper formula is. We'll take all of that in. We'll do a cost-benefit analysis, and then we'll issue a final regulation. And as long as our judgment, our regulation, is not, quote, arbitrary and capricious, those are the terms of the courts use, as long as it has a sound basis to it, then we'll have a final regulation. Having done that, we will require all 6 financial institutions and the aforementioned SIFIs to establish on their balance sheet a line item, just a line item that says subsidy reserve. Retained earnings, just a stratification of retained earnings, a line that says subsidy reserve. Hasn't cost anybody anything yet. Every year, and I mean every year, at the end of the year, this formula that the Fed, with the input of the public, has instituted is applied to the earnings of the 6 too big to fail banks, all those over $500 billion in assets. And you come up with a number. And that number is put into the subsidy reserve line item. Part of retained earnings becomes now called retained earnings. Part of it is called subsidy reserve. But here are the rules, and this is critical. Remember, I went through what you can and cannot do with your equity. You can pay dividends. You can do stock buybacks. You can pay bonuses to the CEO. You can do all these marvelous things. But you also have to keep capital according to the Basel standards globally, right? The rule here is that this subsidy reserve that we're creating can't be paid to shareholders in the form of dividends, can't be used to do stock buybacks, right? Can't be used for executive bonuses, and it does not count towards your Basel III regulatory requirements, right? But we're not taking it away. We're not taxing it. We're not harming the institution in any way. But we are requiring you to accumulate it, or there's a word, accrete. Do we know that word? Accrete? Add. Every year, it is 1 year's subsidy reserve is added to the next, so it gets larger and larger year over year. The way you can return it to the shareholders is if you, the too big to fail bank, decide to sell assets, right? A subsidiary, a division, a business line, just like J.P. Morgan is going to do, it appears, with its electricity trading company. It is going to spin it off to its shareholders. You know what the term spin off means? you have one of these non-bank affiliates, right? Or you have a business line, and you want to get rid of it. You want to divest it, right? You might want to do it for any number of reasons. In this case, J.P. Morgan will probably want to do it because of the reputational damage it has suffered. There's several ways you can get rid of that. You can hire an investment bank to come in and package it and sell it, find buyers, right? You can form it as a separate company and do an IPO, a new offering. Or you can say, okay, there aren't a lot of buyers for this. Why don't we just form it into a separate company and then spin it off to our existing shareholders? Okay? So it becomes an independent company right away, even though the new shareholders are the same shareholders of the existing company. But because they're public companies, they're constantly traded. And in a short period of time, you have new shareholders. So the way this subsidy reserve is returned to the shareholders is in connection with the sale of assets, the divestiture, the spin-off, the IPO, the alienation of a part of the organization. So if I'm Bank of America, say, and I sell a subsidiary to a third party, and it constitutes 10% of my assets, then guess what? 10% of this subsidy reserve can now be returned to retained earnings, and it can be used for dividends, and it can be used for stock buybacks. And if Brian Moynihan, who happens to be the CEO of Bank of America, is so greedy, he wants to take it in the form of a bonus, he's free to do that. But if you don't do that, as I said earlier, it just gets larger and larger and larger. Big numbers. Big numbers. So you tell me what happens if Bank of America, Brian Moynihan, is sitting there as the CEO 5 years from now, 3 years from now, and he has accumulated 3 years, 5 years of earnings and has a reserve on his balance sheet of this magnitude. What do you think will happen? He will try to sell something. And if he does not sell something, we'll find somebody who will. Right. Because his capital and his performance ratios as a company are going to be injured. Right? Good news is that Bank of America's capital, remember, the regulators worship at the altar of capital. Capital keeps getting larger and larger to the point where maybe Bank of America isn't too big to fail anymore. If it has 50% capital, that's a pretty safe margin. But it would never get to that. You're absolutely right. This is not government intervening. This is, remember we talked about market discipline and sound regulation? This is market discipline. This is simply recognizing that a certain category of institutions are getting a subsidy not because they're good or providing a public service, but because their business model constitutes a threat to our financial system. And using that subsidy to mobilize market discipline, to remove them from being too big to fail anymore. Obviously, the way the thing plays out is if you divest enough of those assets, then you become small enough or less complex enough so that you're no longer too big to fail. We've talked about that. It's transparent. It's fair. Well, this is a bill. This is a proposal. It's not a law. Yeah, part of the materials is the bill and an article written by in the American Banker, which is a daily, talking about the bill. What I left out here in terms of this is, in the U.S., we have something called the General Accountability Office, which is the accounting arm of Congress. Okay? Very well known, very well respected. It has been requested by two senators, one very, very conservative Republican, one very liberal Democrat, got together and they petitioned the GAO, the General Accountability Office, to do a subsidy to work through all of these academic and other studies that have analyzed what the true amount is. And that GAO study is due January or February of 2014. The hope and expectation, at least my hope and expectation, not a too big to fail bank's hope and expectation, is that that study will confirm earlier studies to the effect that we're dealing with very, very substantial numbers here, too large to be ignored. And just a political commentary, as you may know, we talked about the Tea Party earlier. One of the principal philosophies that they have is that there will be no more taxes. No more taxes, according to the Tea Party. And they control the House of Representatives, and in the U.S., any tax initiative has to begin in the House. So even in the face of an $83 billion annual subsidy documented, politically, it would be unlikely that they would tax that away from the too big to fail banks, which would be a fair way to deal with this issue. But something like this plan puts that philosophy to the test, because it is not a tax. It is the free market at work, right? We shall see whether it happens or not. So any questions, comments about this plan? Okay. The only thing left for me to do is to thank each and every one of you for allowing me to visit your country and your city, and you, all of you, and spend the last 2 days. It's been totally delightful. I intend to go home with a very favorable impression of your country and all the great things that are going on here, and spread the word, because it's It's a shame that it's not better known, your story, because it's a wonderful story. I had a chance Saturday and Sunday. Natalia arranged for me to be taken all around the area, and I was just so impressed, not with just the sites and the churches and the monuments, but with the people and the spirit of renewal and hope that I saw, also in the face of very, very real challenges. What I see your opportunity is to really make a change. I'm not you might have guessed that I'm not a young person anymore. And people ask me, well, why are you still doing this? The reason I'm still doing it is all of this stuff that we talked about. My generation didn't get it right at all. So if I can teach other people about the mistakes that we made, I think I will be doing a good service. You and I are in the same business. I am an educator. You are an educator. We talked about financial literacy, right? This is financial literacy at a high level. But drive it down to the lowest level, and you may not see the progress next year or 5 years from now or 10 years from now, but I envy you for the potential that you have to make truly positive and meaningful changes in your countries simply by telling the truth. So thank you very much.